If you look at the investment portfolio of the average person, it usually looks like a random collection of ideas. They have a 401k from an old job, a few tech stocks they bought because a friend recommended them, maybe some crypto, and a savings account earning almost nothing. There is no architecture, there is no strategy. It is just a pile of assets hoping to go up. I have been a wealth manager, fund manager, and real estate broker for 30 years. I have structured portfolios for high net worth clients who demand absolute precision in how their money is deployed. And I can tell you that the wealthy do not buy random assets. They build portfolios with a specific intentional architecture. Today, I'm going to show you exactly how professional investors structure their money. I'm going to teach you the core versus satellite formula, the exact portfolio architecture used by institutional investors to capture the massive upside of the market while strictly limiting their downside risk. If your portfolio is just a random collection of stocks and funds, you are taking on unnecessary risk and leaving money on the table. You need to watch this video. Let's look at the architecture of wealth. Let's start by understanding why random investing is so dangerous. When you buy assets without a unifying strategy, you usually end up with what we call concentration risk. Let's say you work in the tech industry. You receive company stock as part of your compensation. Because you know the tech industry, you also buy shares of Apple, Microsoft, and Nvidia in your personal brokerage account. You feel diversified because you own 4 different companies, but you are not diversified at all. You are massively concentrated in one sector. If the tech sector experiences a downturn, your company stock drops, your personal portfolio drops, and your job might even be at risk. All 3 pillars of your financial life collapse at the same time. This is the danger of investing without architecture. Professional investors never allow this to happen. They build portfolios designed to survive any economic environment. They separate their money into 2 distinct categories, the core and the satellite. This is the core versus satellite formula. The core versus satellite formula is a portfolio design that divides your capital into a massive, stable foundation and a smaller, aggressive growth engine. Here is exactly how it works. The core, 80% of your capital. The core is the foundation of your wealth. It represents 80% of your total investable assets. The purpose of the core is not to make you rich overnight. The purpose of the core is to guarantee that you capture the long-term growth of the global economy with absolute certainty and minimal fees. The core is never invested in individual stocks. It is never invested in speculative assets. The core is invested in broad, low-cost index funds, or ETFs, that track the entire market. This money is boring. It is passive. You do not touch it. You do not trade it. You let the compounding engine of the global economy do the work for you over decades. The satellites, 20% of your capital. The satellites represent the remaining 20% of your portfolio. This is your aggressive growth engine. The purpose is to generate alpha. Because your core is secure, you can afford to take calculated risks with your satellites. This is where you invest in individual stocks that you believe have massive upside potential. This is where you might allocate a small percentage to emerging markets or specific sectors like artificial intelligence or renewable energy. If one of your satellite investments goes to zero, it does not destroy your financial life because it was only a small percentage of your total portfolio. But if one of your satellite investments goes up 1000%, it significantly boosts your overall net worth. This architecture gives you the best of both worlds, the absolute security of the broad market and the massive upside potential of targeted investments. Building the core versus satellite portfolio is only the first step. The secret to making it work over decades is a discipline called rebalancing. Let's say you set your portfolio at 80% core and 20% satellites. Over the next year, your satellite investments perform incredibly well. They double in value. Now, your satellites make up 35% of your total portfolio and your core has shrunk to 65%. Amateur investors look at this and say, great, my aggressive investments are winning. I'll just leave them alone. Professional investors see too much risk. So they rebalance. They sell off the profits from the satellites and they use that cash to buy more of the core, bringing the portfolio back to the strict 80-20 architecture. This forces you to do the one thing every investor struggles to do: sell high and buy low. You are systematically taking profits from your winners and moving that capital into your stable foundation. This discipline is what protects your wealth during market crashes and ensures you keep the profits you make during bull markets. Investing without an architecture is gambling. Investing without an architecture is gambling. If you want to build generational wealth, you need to structure your portfolio like an institution. You need a massive, stable core and targeted, aggressive satellites. But building and managing this architecture takes time, discipline, and emotional control. Most people fail because they let their emotions dictate their trades. That is why I built my Robo-Advisor platform. I took the exact institutional portfolio architecture I have used for 30 years. The core versus satellite formula, the strict asset allocation, the automated rebalancing, and I coded it into an automated platform. If you want your money managed with the precision of a family office, without the massive management fees, click the link in the description below to open an account with my Robo-Advisor. You deposit the funds and the algorithm builds the architecture, manages the risk, and executes the rebalancing automatically. Stop gambling with random assets. Start investing with architecture. I'm JM. Thank you for watching, and I will see you in the next video. This is not financial advice. Do your own research.